Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello my dear students. In this video, in about couple of hours, we will be revising this very important chapter, financial instruments. I know a lot of students who find this chapter to be lengthy, complex, difficult, and they're generally scared about this chapter. Now, one thing through this video, what I want to communicate to you is that the theoretical part, the concept part of this particular standard or of this particular chapter is very long, no doubt about that. But with the right kind of preparation and revision and solving the right type of questions, you will be able to get at least 90 to 95% confidence in the examination. Meaning to say, 90 to 95% of the questions which are generally asked in the examination, you will be able to solve. So, don't worry about this being a very lengthy chapter. Be with me in this entire video, and I guarantee you that in out of 14 marks question, typically 14, sometimes you get 18 marks, sometimes you get 20 marks including MCQ. If you get a 14 marks question, you will have a confidence to score 10 to 12 marks. And this is one chapter where if you do it properly, stepwise, correctly, chances of scoring very high marks are there. Okay, so here, once you have understood how to approach few types of problem, and as you watch this video, you will understand that there are only specific type of practical problems which are asked in the examination. So, with that practice, you will be able to complete this chapter and attempt this chapter with 100% confidence in the examination. These notes are available in our free resources section, also in our Telegram channel. You can take it up from there. And not only this, I have also completed business consolidation and business combination in the previous videos in about 2 hours plus 2 hours, in about 4 hours. Both of these chapters also you can revise thoroughly. Now, without wasting much time, let us jump into the revision of financial instrument. This is purely from an examination point of view. I may pick up some small conceptual topic here and there, but largely it is from examination point of view. Alright. Now, as far as financial instruments are concerned, all of us are aware you have either a financial asset or you have a financial liability and equity. Financial instrument is financial asset for one entity, and for the other entity it is either financial liability or equity. A quick recap of what is financial asset: cash deposit with bank. So anything you have in cash, cash in hand, cash at bank is a financial asset. Then if you have a right to receive cash, it also is a financial asset. If you have a right to receive cash, for example, from trade receivables, advances given to other, loan given to other, if you have a right to receive cash, it is a financial asset. If you have a right to receive another financial asset, then also it is a financial asset. Now, sometimes what happens is you give advance. You have given advances to suppliers, but you will not get cash or another financial asset. You will receive goods. If that is the case, then it does not fall within the purview of this financial asset. Then, if you have an obligation to deliver cash or another financial asset, then it becomes a financial liability. If you have to receive cash, financial asset. If you have to deliver cash, financial liability. So, if there is an obligation to deliver cash, it's a financial liability. Otherwise, it's a financial asset if you have a right to receive. Then, any equity instrument of another entity. So, if you hold shares of, let us say, Reliance, a company holds shares of another entity, this equity, that is also a part of financial asset. Then, very importantly, if you can exchange financial assets or financial liability in favorable terms, then it becomes a financial asset. But if you exchange financial asset or financial liability and the terms are unfavorable, then it becomes a financial liability. What do I mean by that? Let me give a quick example. Say for example, you have sold options which are call options. You have sold call options on, let us say, Infosys. Strike price or exercise price is 1000. Current market price is 1100. There is another party, your friend, who has bought this call from you. Bought 1000 call option of Infosys. Right. Now, the market price is increased to 1100. When you sold it, or the strike price for which you have sold is 1000, you have collected some premium for that. Let us say you have collected a premium of 30. Now, the price has become 1100. If you look at it from your friend's perspective, friend has purchased 1000 call options of Infosys. Now, for the buyer, your friend, he is in a advantage, he has some profit, because he can buy at 1000, he can sell in the market at 1100, he is in a favorable position. So for him this becomes a financial asset. Whereas for you, you have agreed to sell at 1000, and what is the current market price? The current market price is 1100, means you are at a disadvantage, the position is unfavorable. So if the position is unfavorable, this becomes a financial liability. Now this I gave with an example of a derivative. For any contract, if the exchange would result in a favorable position, then it's a financial asset, otherwise it's a financial liability. So if you exchange financial asset and financial liability in favorable terms, then it becomes a financial asset. If you exchange and the terms are unfavorable, then it becomes a financial liability. Then there is something on settlement on in own equity on both financial asset and financial liability side. This is not much relevant for the exam. Here what you need to understand is, if the settlement in own equity is out of a non-derivative contract and variable number of equity are to be issued. So this is what is important. If variable number equity are to be issued, I have entered into a contract and I have agreed that I will issue so many number of shares based on the price on a future date. In that case, the number of shares are not decided. I am not saying that I will give you 10,000 shares. I am saying that I will give you so many shares such that the value is 1 lakh. The value is 1 lakh, or depending on the price, I will give you some number of shares. If that is the case, if the number of shares are variable and if I have agreed to give it to you, then in that case, this becomes a financial liability. Similarly, if there is a derivative contract which is not fixed to fixed, again we can consider variable for examination purpose. If it is not fixed to fixed, then also it becomes a financial liability. Now here what is important? You are settling in own equity. So if you have a contract to settle in own equity and the number of shares are not fixed, and in case of derivative contract even the consideration is not fixed, it is not a fixed to fixed contract, then it becomes a financial liability. Whereas if you settle in own equity and it is not variable, that is fixed or fixed to fixed number of shares for a fixed consideration, then in that case this becomes an equity. For example, for share based payment transaction, you have fixed number of shares, you have fixed consideration. You have any stock option, fixed number of shares, fixed consideration, then that becomes your equity. Alright. So quickly recap, for financial liability, obligation to deliver cash, exchange financial assets or financial liability which becomes unfavorable, and you have, let's say example is if you have sold an option. If you settle in own equity by variable number of equity or not fixed to fixed in case of a derivative contract, then in that case this become a financial liability. What is equity? Equity is residual interest which is of the entity. It is not a financial liability. So if anything falls within financial liability definition, you will consider it to be financial liability. Otherwise, equity, that is if I have an residual interest in the entity, that becomes my equity. And if you settle in own equity, it should not be variable or it should be fixed to fixed in case of derivative. These are the key terms you need to remember as far as definitions are concerned. That is the first part. Then a quick important note from MCQs point of view. If there are gains, it is a derivative asset. If there are losses, it's a derivative liability. Then when we have redeemable preference shares, we will discuss this subsequently as well, it becomes a financial liability because there is an obligation to deliver cash. And please remember, all of these have to arise out of a contract. There has to be a contractual right or a contractual obligation. If it is something related to refund of taxes, income tax refund and all of that, those do not arise out of contract, and hence those are not within the purview of this particular topic. Okay. Now, certain exception from the definition of whatever we have learned in financial instrument. If you have a puttable financial instrument, puttable means what? Puttable means there is a holder. The holder can put back the instrument to the issuer. Typical example, mutual fund unit holder. Now, if you see, if I hold mutual fund units, typically I am a owner in the mutual fund, correct? because if whatever units I hold, that entitles me to ownership rights. But if I am an owner, which typically has to be classified as equity, that is what if I am an owner, if I have residual interest, it is an equity. For mutual fund unit holders also, what they are entitled to is to the net asset of the mutual fund, But in case of equity, typically it is the residual interest you pay them at the last. Whereas for mutual fund unit holder, they can go and ask for redemption whenever they want. If I have purchased, let us say 100 units of mutual fund today, I can go after 1 week and ask for redemption. So if you look at this does not fit into the criteria of being an equity, because I am able to take money whenever I want. So here we have an exception which says that if you have certain puttable financial instrument, puttable means it gives the holder the right to put the instrument back to the issuer. I have mutual fund units, I can give it back to the mutual fund and ask for money. And or another scenario is automatically put back to the issuer due to the occurrence of an uncertain event. So if some event has been defined, for example, let us say completion of a particular milestone. If a milestone is completed, and it is automatically put back to the issuer. Now in such a scenario, because it is not the residual interest as in technical terms, it is being called upon earlier, and if I give the unit back to the mutual fund, they have an obligation to pay cash to me, it would have been classified as a financial liability. But this is exception, because of which these puttable financial instruments are classified as equity. Due to this exception, mutual fund or any other puttable instruments are classified as equity. What are the conditions? The conditions to be satisfied, and the reason I am discussing this is important from MCQ point of view. That's the only reason. Alright. Holder is entitled to pro rata share. Yes, a mutual fund unit holder is entitled to pro rata share in the entity. It is subordinate to all classes of instrument. If at all the mutual fund had to be liquidated, the mutual fund units are subordinate, means they will come at the last. All financial instruments in most subordinate class have identical features. Features are identical. No other contractual obligation to deliver cash or financial asset. Means there is no other contractual obligation to deliver cash or financial asset. Expected cash flow based substantially on P&L, changes in net asset or fair value of net asset. Now if you look at a mutual fund unit, if the price increases, if the net asset increases, that is when my net asset value or value per unit increases, right? And there are no other financial instrument or contract that has the same terms as this, with effect of substantially restricting or fixing the residual return to the puttable financial instrument holders. So the last one what it says is there are no other financial instrument or contract which has similar terms which are given in 5. Okay, important, as I told you from MCQ point of view, don't break your head in trying to overboil or keep on reading again and again. Read it 2-3 times, that is more than sufficient. What you need to understand is if these conditions are satisfied, then the puttable financial instrument, which typically would have been classified as liability, would now be classified as equity. I hope it's clear. Then we have another small concept of own use exemption for non-financial asset. Now what is this own use exemption? Again, an example would be better. Let us say I trade in copper. And what I have done is I buy copper, I sell copper and all of that. I have entered into a contract to buy copper after 6 months. I have entered into a contract to buy copper after 6 months. Now this becomes in essence a nature of forward contract. And if it's a forward contract, it would be a derivative. And if it's a derivative, it would be covered by financial instrument Ind AS 109. Now what the standard says is, if there is something which is own use means for your own purpose, for the usage in the business. For example, I have bought copper forward. Now this copper forward is based on a non-financial asset. I'll actually buy copper in the future. That is for the purpose of buying copper, taking delivery of copper and selling it subsequently. Then if the contract is gross settled, it is not covered in the purview of financial instrument accounting. What is the meaning of that? I have agreed to buy 1000 tons of copper after 6 months. If I actually take delivery of 1000 tons and give equivalent amount to the supplier, then that part is not covered in financial instruments. It will not be called a financial instrument. Whereas, if I have a practice of net settlement, sir, what is the meaning of net settlement? So, say when I purchased copper price were 6,000. When I purchased copper prices were 6,000. After 6 months, the price went up to 7,000. Now, if the price went up to 7,000, do I gain or do I lose? I gain. So, what I tell the seller is, see boss, I have gained 1,000. You pay me that 1,000, let us close out the contract. If that is the thing that happens, then we call it net settlement. If it is net settlement, then it is covered under accounting for financial instrument. And then, if you have a FVTPL designation to avoid accounting mismatch, even then it is covered. This you will understand slightly subsequently. Okay. Now, what is this FVTPL designation to avoid accounting mismatch? Typically, what happens is, if I have, let us say, another example, if I have bought copper, and to hedge, I have sold copper futures. Here also it is for own use only, or I have sold copper forward. Here also it is for own use only, but the idea is to avoid losses. Idea is for hedging purpose, such that if the prices increases or decreases, it does not impact my P&L. Then in that case, I will designate it as FVTPL, which you will understand subsequently, and then this will be covered under financial instrument. And as far as net settlement is concerned, how do you determine? You check either the past practice, is the entity settling on a net basis in the past, or if the entity will sell it in the short term immediately after taking delivery, or it is readily convertible to cash. These are some indications to check whether it is net settled or not. Okay, so this is the conceptual part of financial assets, financial liability and equity. Now, the most important thing for accounting of financial instruments or financial instruments, financial assets, financial liability and equity, first we need to understand what is the classification. Where do we classify financial asset? Now, financial asset, how many types are there? There are 3 types of classification. One is called the amortized cost method, then you have fair value through other comprehensive income, and then you have fair value through P&L. As far as amortized cost method is concerned or FVT OCI is concerned, you have to check what are the contractual cash flow, and the contractual cash flow should be only principal plus interest. The contractual cash flow should be only principal and interest, and the objective should be to hold till maturity. If this condition is satisfied, means it is only principal plus interest and the business model is to hold the instrument till maturity, then we classify it under amortized cost method. You can do only for debt. Okay. Equity will never come into amortized cost method. Please keep this in mind. Then, second category is FVT OCI. Here also there are 2 categories. One, you have principal plus interest as the cash flow. Contractual cash flow is solely the payment of principal and interest, and the objective is to sell. Means you will earn interest and you may sell in the near future to take advantage of interest rate changes. If that is, this selling criteria is there, then it becomes fair value through other comprehensive income. Now, under fair value through other comprehensive income, we also have equity classification. Equity is generally carried at FVTPL, but if the entity chooses to do so, they can classify equity under FVT OCI method, and this is irrevocable. Once you have designated, you cannot get it back to FVTPL. Okay. Now, as far as amortized cost method is concerned, you will account for it using effective interest method. We will calculate the EIR. This is typically given to us in the examination. We will see that with a number. Then, initial recognition is done at fair value plus or minus transaction cost in some cases, but generally fair value plus transaction cost. Otherwise, if there are upfront processing fees and all being paid, then it will become fair value minus. Okay, so it depends. If you are paying it, it will be added. If you are receiving, then you will reduce. Okay, so it may be plus or minus. Typically, it is plus transaction cost. For FVT OCI also, it is fair value plus transaction cost, or in some cases minus transaction cost. Every TPL, it is only fair value. What do we do with the transaction cost? Transaction cost is taken to. Alright. Now, for amortized cost method, every year you will account for interest using effective interest method, and carrying amount is nothing but opening balance plus interest, income minus payments, whatever you have received. And here, carrying amount will be fair value. Fair value changes will be taken to percent. Now, one thing you have to keep in mind is calculation of interest for both amortized cost method and FVT OCI, the table will be same. The table will be same, table will not be different. Okay. As far as FVTPL category is concerned, if there is any derivative, that is a residual category, derivative will always go to FVTPL. If it is trading, again it will go to FVTPL. If there is accounting mismatch, as I told you, there is inventory and there is derivative on inventory. Inventory goes to P&L, so this derivative will also go to P&L. Okay. If there is some impact, let us say it's on investment, and that investment in subsidiary is under OCI. If you have taken any hedges, that will also go to OCI. Okay. So for in those purpose, wherever it goes, that is where you will take it. But if something hits the P&L, the second part of it, you will understand more of this in hedging, that also will go to P&L. Now, very simple example for just a quick recap. For amortized cost method, let us say loan amount is 10 lakhs, tenure of loan is 5 years, rate on loan is 5%, market rate is 8%, upfront fee paid by the borrower is 1 lakh 20%. Now, here one thing that you have to understand is this rate of loan, this 5% that you see, this is nothing but your coupon payment. Coupon payment, or you can say cash flow. Every year on 10 lakhs at 5%, 50,000 will be paid. Every year on 10 lakhs at 5%, 50,000 will be paid. Who will pay? The borrower will pay to the lender. Okay. Now, when we are talking about accounting for financial asset or accounting for financial liability, here we are talking about financial asset. The lender will recognize it at fair value. Lender will recognize it at fair value. What is the fair value? Fair value is present value of cash flows using the market rate of interest. So, here if you see, the rate of loan is 5%, market rate is 8%. Market rate is 8%. Now, sometimes this market rate will have to be updated because sometimes what happens is you have processing fees or you have transaction cost. Because of that, you have to update the market rate. If there are no transaction cost, the market rate is what would be used. But if there are transaction costs, then what you do? You take the market rate. You take the market rate and you will update it to calculate the effective interest rate. You will calculate the effective interest rate. In this case, the rate is 8%. After considering all the processing fees and all of that. This rate is generally given to you in the examination question. In the exam, they will give you both the rate payable, let us say the effective interest rate, which is 10.5%, maybe this is the market rate. You will always consider the effective interest rate. Okay, you will never consider coupon for interest expense, or you will not consider the rate of loan for interest expense. You will always consider effective interest rate if available, otherwise you will use the market rate. Sometimes if effective interest rate is not given, typically that doesn't happen, then you have to compute something called as IRR using the interpolation method. Okay. So here what we will do is we will discount the present value of payments at 8%, which is the effective interest rate. Using the effective interest rate, we will discount it by 8% and get to the present value. What we will discount? We will discount the principal plus interest. We will discount the principal plus interest, means whatever you will pay after 5 years and interest. Interest is what? 50, 50, 50, 50, and finally you will pay 10,50,000. At 8% when you discount it, you will get the present value, which is 8,80,230, or rounded off to 8,80,000. Typically, the fair value is the transaction price. If you have transaction cost, plus or minus transaction cost. So, step 1, whenever you get a question on loan, amortized cost method, financial asset, financial liability, you will calculate present value of the payments. You will calculate present value of payments at effective interest rate. at effective interest rate. This is the value at which it will be initially recognized. So initially for the lender, you will say financial asset 8,80,000 to bank 8,80,000 to bank 8,80,000. Now what will the borrower do? Borrower would say debit bank 8,80,000, credit liability 8,80,000. After that, you will prepare something called as an amortization schedule, which has opening balance, interest at 8%, payments at 5% and closing balance. Opening, interest, payment, closing balance, all of you will be aware of this. This amount of interest every year will be debited to P&L or the income statement. So, debit financial asset 7,400 for the first year at 8%. Credit interest 7,400 or interest income. Then debit bank 50,000, credit financial asset 50,000. Whatever amount is received, you will debit. You can combine both of this and pass a single entry as well. So when it comes to amortized cost method, first you will consider what? First you will consider what is the present value of all the payments discounted at effective interest rate. After you have discounted, you will record it at the fair value of 8,80,000 in this particular case. Every year you will record interest income and all the payments will be credited to financial asset. For these two, you can pass a single combined entry as well. So how do we account for FBT OCI? FBT OCI also will do it in the same way, just that at the end you will compare this closing balance with fair value. You will compare the closing balance with fair value. If there is a fair value gain, you will credit it to OCI. If there is a fair value loss, you will debit it to OCI. Alright, now FBT OCI interest calculation is done using effective interest method like in case of ACM, and the difference is recognized in OCI. Then as I told you, you have an option to classify equity under FB OCI. This is irrevocable, and on derecognition, if there is any balance in this OCI, that will be transferred to P&L except for equity.
It's 3 o'clock.
If you have designated equity under FVOCI, then on derecognition also you cannot transfer it from FVOCI to P&L. Whereas in case of other instruments which are there under FVOCI, that you can transfer to P&L on derecognition. Alright. So let us look at one example. You have investment in debentures 1 lakh. Transaction cost 2,000. So how much did you pay? 1,02,000. This is the transaction price. Initially you will recognize it at transaction price, which will be equal to your fair value adjusted for transaction cost. Return on interest is 10%. Tenure is 3 years. Effective interest rate is 9.207. So this effective interest rate is used to calculate interest income, and this is used to calculate payment. Now when this information is given, no need to separately calculate the present value. Even if you calculate the present value, you will get 1,02,000. So opening balance 1,02,000, interest at effective interest rate, payment at coupon rate, closing balance. Okay, so 101, 1 lakh, 1,07,000 and 1 lakh is the closing balance. Now what you have to do is, if you are following FVOCI, then you will compare this closing balance with this, and the difference between 1,01,000 and 1,05,000, this will be recognized as gain. Then in the second year, closing balance is 1,07,126. The fair value is 1,02,000. The difference. So here FVOCI was how much? 1,01,391. That is what you have carried. Now 1 lakh, it has become 1,02,000. You have to separately calculate what will be the FVTOCI carrying amount before fair value gain. Meaning to say, if you take the closing balance of previous period, which is 1,05,000, closing balance of previous period is 1,05,000 plus interest income 9,335 minus payout 10,000. If you do, you get 104,335. You get 104,335. This 104,335 you will compare with the fair value of 1,02,000. You get 2,335 of subsequent loss, because this is carrying amount, this is fair value. Okay. Then third year, carrying amount 1 lakh, fair value 1,01,274. Sorry, carrying amount 1,01,274. Fair value is 1 lakh. The difference will be the loss. So what you have to do is, this interest will be same as per ACM, but carrying amount will change because you will take opening balance plus interest minus payment to arrive at the carrying amount. Okay. Accordingly, you will calculate the gain or loss. Then, any financial asset which can be measured at ACM or FVT OCI can be designated as FVTPL, which is again an irrevocable choice, and equity instrument which is not held for trading, you can designate it as FVT OCI. Alright. So, this is the summary of how do you do the accounting for it. Now, moving on, sometimes what happens is, and this is important from examination point of view, you keep on getting questions on employee loan, loan by holding company to subsidiary company and all of that. So, if the transaction price is not happening as per market, so what is the meaning of that? Say for example, the rate in the market is 10% and I have given to my employees at 8% or at 6%. So, if it is not happening at this rate, if it is not happening at market terms, then what you will do, the difference between these two will be taken to P&L if it is based on L1 or observable inputs. In other cases, it will be deferred and treated as asset if it qualifies as an asset. But, so this is how you will normally do. So, typically what happens is, the type of question you get in the exam is loan given to employee, leases you have given, parent to subsidiary you have given the loan, subsidiary is given to parent, subsidiary is given loan to the parent. In all of these cases, what do we do for the difference? So, which difference? Difference between the transaction price and the market price. What happens is, if you have given to employee at let us say 8% and the market rate is 12%, you have given at 8%, you have given at a lower rate, then the difference between fair value at 12% and the transaction price will be debited to prepaid employee benefit expense, and over the service of the employee, you will expense it out. Similarly, if you have leases, then it is considered as, if it is leases, you have given let us say interest free deposit. You will calculate present value of deposit at market rate, compare it with the interest free deposit. Any difference that is there, if there is any difference, that difference will be added or considered as prepaid lease rent. Now you will consider it as a part of right of use asset. Okay. Then parent to subsidiary. If parent has given discounted loan to the subsidiary, the difference between the fair value of the loan and the actual loan given is treated as investment, and subsidiary giving to parent, then it is considered as a part of dividend. Whereas, if the transaction is at market term, then the fair value is the transaction price and you will compute EIR, if at all you need to compute EIR because of the transaction cost. Okay. So, these questions, let us have a look at it now. A Limited has made security deposit for lease whose details are described below. Make necessary journal entries for accounting of the deposit in the first year and the last year. Assume market interest rate for deposit is 12%. Date of security deposit 1st of April. Date of security deposit finishing date 31st March. Total lease period 5 years. Discount rate 12%. Security deposit 10 lakhs. Now, we have given interest free deposit of 10 lakhs for how many years? 5 years. Means we will get back 10 lakhs after 5 years. We will get back 10 lakh after 5 years. If I am getting back something after 5 years, is it my financial asset or financial liability? It is of course my financial asset. I need to know what is the present value of this financial asset. So, they have given the factor of 5, 6, 7, 4 to 7. They have given factor of 5, 6, 7, 4 to 7. In the examination, if they give the factor, use the factors as it is. Otherwise, use 3 decimals. If the numbers are given in crores or lakhs or something like that, you can use 4 decimals. Okay. So, present value of the deposit is how much? 567, 427. Amount of deposit is how much? 1 lakh. So, this is the amount. This is the fair value of deposit. Means you have paid 432, 573 extra. What is this called? This will be added to right of use asset or prepaid lease rent. There is also a term used. But now because of Ind AS 116, any amount you pay in advance, is added to what? Right of use asset. So, you will add it to right of use asset and you will depreciate or amortize it over the life of the asset. So, then what about this 567? This 567 becomes my present value of lease deposit. Every year I will add interest to this and finally I will reach to an amount of 10 lakhs. So, you will prepare an interest schedule, opening balance, interest at 12%, closing balance. Again, this becomes opening balance. Like that, if you do, you reach to 10 lakhs. And the total of 432,573 divided by 5, what you get? 86515 is amortization. So first year entry, initial recognition, security deposit, this is at present value 567. Difference is right of use asset to bank 10 lakhs. End of year 1, any interest income you will add to security deposit and the interest income will be transferred to P&L. Amortization of right of use asset for the RU amount and transfer to P&L. For the last year, interest entry, amortization entry and receipt entry. Simple and straightforward. Now let's look at this exam question, and if you see these type of questions when they come for 14 marks, and if you do it carefully, you have to be very careful to take the correct rate, you have to be very careful to take the correct amounts and information from the question. If you are able to do that, 14 out of 14 is not difficult. That is what I am saying. You will get 14 out of 14 or 10 out of 10, 12 out of 12. It is possible. Okay. So my request is, don't, at least if you don't want to do the entire chapter once again, at least go through this 50-55 page of question which has come in the previous periods, and you will have some confidence to go and write the examination. Alright. Now, Autumn Limited has a policy of providing subsidized loan to its employees for their personal purpose. A senior HR manager in the company took a loan of 12 lakhs on the following terms. What are the terms? Interest rate at 4%, loan disbursed on 1st April. Principal amount of the loan shall be recovered in 4 equal annual installments commencing on 31st March of 20. Now, whenever there is an employee loan related question, what has happened is, they will use some tricky word. Sometimes they will say quarterly recovery of interest, yearly recovery of installment. Sometimes they will say first we will collect principal and then we will collect interest. So you have to read this very properly and calculate it correctly. That is the only trick. The principal amount of the loan shall be recovered in 4 equal annual installment. What is the principal amount? 12 lakhs. So 12 lakhs divided by 4, you will get how much? 3 lakhs. Every year, the cash inflow for the company is 3 lakhs. The accumulated interest computed on reducing balance at simple interest, so there is no interest on interest, is collected in 3 equal annual installment after the collection of principal amount. What are they saying? They are saying that interest has to be on simple interest basis. First year you have 12 lakhs of loan outstanding at how much percent? 4%. Into 4%. This is 12 lakhs into 4% is 48,000. Okay, first year interest. Second, what they are saying is we will collect 3 lakhs at the end of the first year. Second year now you have 9 lakhs. Now on this 9 lakh you will calculate 4% interest. You will not calculate interest on interest. So this becomes 36,000. 48, 36, next year it will be 24,000 and the year after that it will be 12,000. You can calculate. Okay. So what is the cash flow? Cash flow is 3 lakhs, 3 lakhs, 3 lakhs, 3 lakhs. This is the cash flow. Oh, sorry, here 3 lakhs, 3 lakhs, 3 lakhs, 3 lakhs. This is the cash flow. Then what is the total interest we calculated? Total interest is 48 plus 36 plus 24 plus 12. Total interest is 1,20,000. This will be recovered in 3 installment. Divided by 3. If I do, I get 40,000. So I have 40,000, 40,000 and 40,000. So what we will do? We will take the present value factor at 9%. If again present value factor is given to in the question, use that and you compute the present value. Basically, so the present value is how much? 1043,638. 1043,638. What is the loan amount? Loan amount that you have given is 12 lakhs. Loan amount that you have given is 12 lakhs. Out of this 12 lakhs, the value of the loan or the fair value of the loan is how much? 10,43,638. So the difference between 12 lakhs and 10,43,638, this 156,362, this will be taken to prepaid employee cost. Okay. Now, for this also we need to prepare a schedule. Opening balance of 12 lakhs, right? Interest at 48,000. That will be charged. Amount collected 3,000. Closing balance is 9 lakh plus 48,000. So how it works is, you will take 12 lakhs. Okay, on this 12 lakhs, you have to calculate interest at 4%, 48,000. This 48,000, you will not collect it immediately. Out of this 12 lakhs, you will collect 3 lakhs and you have 9 lakhs. Next year, on this 9 lakh interest, you will calculate. That is how you can do the presentation. Now, as far as the interest schedule is concerned, you will consider what is the opening balance of loan, 1043,638. That is nothing but fair value of this loan. On this, you will charge interest at market rate. What is the market rate of interest? Market rate of comparable loan is 9% and Jama Bhai must remain in service till the principal and interest are paid. So, Jama Bhai has to remain in service till what? Principal and interest are paid. So, there is a service condition of how many years? 1, 2, 3, 4, 5, 6, 7 years. He has to be in service for 7 years. Okay. Opening balance, interest at 9%, repayments 3 lakh, closing balance 837. Like this, if you prepare, you will reach the end amount of 0. Now, last year interest you have to adjust for rounding of differences. Okay. Then, the journal entry, loan prepaid to bank. Every year interest income you will add. Loan account will be debited to finance income based on the table 93 207 and bank account to loan whenever you have recovered the loan. Alright. Then they have asked you to prepare loan account. This is a very simple thing. Don't expect these kind of simple ledgers in every exams. Okay. So this is very less likely they will ask. Opening balance, amount received, interest charged, closing balance. You will prepare the loan schedule. Then this prepaid expense they have not asked. They have asked journal entries at the time of initial recognition and as at 31st March and prepare ledger account from the inception till its final payment. Then what about this prepaid 156,362? It has to be expensed over 7 years. 156,362 divided by 7, you will expense 22,337 every year as employee cost. Okay. So that's how you will do. Then Weak Limited, which is a fully owned subsidiary of Strong Limited, approached Strong Limited for interest-free loan to mitigate its financial difficulty. Now, when that happens, what you will do is the present value of loan, 60 lakhs is the loan, present value of the loan is 4762. I hope by now you would be comfortable in calculating this. The difference is credited to equity. So when subsidiary receives interest-free loan, difference will be credited to equity and the parent company will debit it to investment. Okay. So similar questions have been asked multiple times for 10 to 14 marks in the examination and it is easy for us to score these in this type of questions in the examination. Just that the wordings you have to be excess careful with. You have to be extra careful with the wordings. Alright. Now, moving on. Classification and measurement of financial liability and equity. As far as financial liability is concerned, either you will follow amortized cost method if there is principal plus interest. Typically happens in case of loan transaction, debentures, etc. Otherwise, you will use the FVTPL if it is held for trading, avoiding accounting mismatches, derivatives, etc. As far as preference shares are concerned, please understand, if it is irredeemable means there is no contractual obligation to deliver cash flow, it is equity, doesn't happen in India. If it is redeemable, mandatorily redeemable, financial liability. If there is a mandatory redemption which happens, then it becomes a financial liability. If it is optionally redeemable, means there is an option with whom. Option could be with the entity or the holder. If I have the option, I can consider it to be equity. But if holder has the option, whenever he comes and asks, I have to give it. So it will be called a financial liability. Similarly, if it is convertible, compulsorily convertible, equity. If it is optionally convertible, if the option is with the entity, equity, otherwise liability. Then, one more thing that you need to understand is, whenever we are taking something to FVTPL, the gain or loss on changes of financial liability is recognized in P&L. Now, if at all the subsequent changes are due to changes in own credit risk, now what is the meaning of that? Changes in own credit risk means, let us say you talk about Reliance Capital, for example. Now, Reliance Capital, currently they have taken loan at 10% because their credit profile has deteriorated. And if they now have to go and see the relevant benchmark rate, their benchmark rate becomes 12%. Now, all of us know that as far as these interest rates are concerned, if interest rate go down, if interest rate go up, the value of liability comes down. So, for Reliance, now if they are using 12% to calculate the fair value of the liability, the value of the liability would go down. The value of liability, when it goes down, it becomes a gain. Now think of it, because of my credit risk change, there is a gain. And if I recognize that in P&L, how odd it would look. The company is going through troubled times and we are recognizing a gain on restatement of liability. It would look very, very odd, right? So, and it will not be proper representation. So what they have said is, if it is due to own credit risk, you will recognize in OCI, and in all other cases, you will recognize the gain or loss in P&L. Right? There is one more thing you have to keep in mind. This is another important topic which keeps on being tested in the examination. Compound financial instrument. What is compound financial instrument? Compound financial instrument basically has an thing of financial liability and equity. If you combine both of these into a single component, let us say convertible debt. Convertible debt means there are two things. One, there is an interest payment. This interest payment which you do on debt is what? This interest payment that you make on debt, this is a part of your financial liability. And if at all this debt would be converted subsequently, that becomes equity. That becomes equity. Or because it is convertible, the holder can come and ask for conversion anytime. The holder can ask for redemption also. So if the holder asks for redemption, again it becomes a financial liability. So if you have a compound financial instrument which have a feature of both liability and equity instrument, they are called compound financial instrument. And whenever you have a compound financial instrument, you have to split accounting. You have to do the split accounting. Means you will consider what is the fair value of the compound financial instrument minus whatever is the financial liability, the balance you will credit to equity. So how to do that? The question will give you two rates. One is coupon rate. Coupon is, let us say, 10%. Coupon is 10%. Rate of similar instrument without conversion option, let us say 12%. You will calculate fair value of liability at 12%. So that becomes your financial liability. You will see what is the fair value of compound financial instrument, and difference will be taken to equity. Now, as far as transaction costs are concerned, they will be allocated between the liability and equity in the ratio of gross carrying values. So if at all there are transaction costs which are involved, you will allocate them between financial liability and equity. And please remember, equity once measured at cost is not subsequently remeasured. Remeasurement happens only if it's a financial liability or a financial asset. No gain or loss will be recognized at initial recognition. Subsequent measurement of financial liability is based on the classification. If there are transaction costs, you have to recalculate the effective interest rate. Typically, this rate will be given to you in the question. Okay, so let us look at a question on this. Interest free loan we have done. So there are optionally convertible debentures 20 lakhs, coupon is 6%, tenure is 3 years, rate without conversion option is 9%, and conversion option will give you 1000 shares. How do you account for rate? First, what you will do is you will see what is the rate interest payable, 6% of 20 lakhs. So 20 lakhs into 6%, that works out to 1,20,000. You have 3 payment of 1,20,000, and in the last year you will also redeem 20 lakhs. So you have 120, 120, 120 and 20 lakhs. This you will calculate the discounting factor using 9%. Rate without conversion option is 9%. So basically the meaning is, if I had to give these cash flows and if it was 9%, what is the value of the liability? So the value of the liability comes to 1848,156. The difference between total value of compound financial instrument and financial liability is the value of equity. So initial recognition, you will say bank debit to financial liability to equity. Okay. Then for financial liability, you will prepare a table like this: opening balance, interest, payout, closing balance. So the closing balance of the liability becomes empty. Now at the end of the period or in between also, if at all the conversion happens, if the investor says I want to convert it, if the investor says I want to convert it, then what you will do, whatever is the amount in financial liability plus whatever is the amount in equity, equivalent of this you will add, transfer to equity share capital plus securities premium. Then if there are transaction costs incurred, let us say 1 lakh is the transaction cost. So what you will do, you will split that between the liability and equity in the proportion. So 1 lakh will be split between 1848 and 151. So what you will do, basically 1 lakh multiplied by 1848 156 divided by 20 lakhs. So when you do, you get 92408 and 7592. proportionately you will allocate. Then you will subsequently calculate the effective interest rate of financial liability, because financial liability amount has reduced. Earlier, if you see, financial liability was 1848, now it is 1755, the rate will increase. This rate will be given to you in the exam. If it is not given, you have to use the IRR method. Rarely it happens that you need to calculate this in the examination. If it is converted, you will debit the financial liability and convert that to equity. ABC issued 10 lakh compulsorily cumulative convertible preference shares. Compulsory cumulative convertible preference shares means CPS. So conversion is compulsory, means there is equity, but it also has cumulative preference shares and they have issued at 150. Rate of dividend is 10% payable every year. So here you have to understand that you have to pay every year, because it is cumulative. Even in subsequent period you may have to pay. So 10% is payable. The preference shares are convertible into 5,000 equity shares of the company at the end of 5th year from the date of allotment. When the CCPAs are issued, prevailing market interest rate for similar debt is 15%, transaction cost is 2%. So this is the overall thing. Right? Now, what you have to do is, you have to see what is the liability. Liability is only the annual dividend of 10%, 1,50,000. This you have to discount using the market rate of 15%. You will get a number of 5,02,830. So 150 into 3.35, 150 into 3.35, you get 5,02,830. Out of this, 2% is transaction cost. So 10,000 is transaction cost, balance is the liability component. How much is equity? Whatever is the balance, from 15 lakhs you reduce 5,02,000, 997 is equity, 19,000 is transaction cost, this is the net amount. How to calculate transaction cost? If percentage is given, directly multiply the percentage with this component, you will get the number. Then, effective interest rate is 15.86%. So, for liability, you will consider 15.86% and calculate the amount. And when it's converted, 5,000 shares, face value is 50,000. Total equity, how much was the equity? 977, 226. Liability we have closed. Liability we have already transferred. So that is already closed. So you will debit equity, credit equity share capital, and credit securities premium with the difference amount. So there will be a lot of similar questions on compound financial instrument. Very simple. Calculate present value of cash flows. Compare cash flows using which rate? Market rate. Compare that with the transactions, total transaction proceeds, difference will be credited to. Now, sometimes what happens is there could be an early redemption of compound financial instrument. If that is the case, then you will compute what is the financial liability as on that date, considering present value of future contractual cash outflows at market rate. So, what would be the financial liability on that date, and balance would be considered as a redemption of equity component, which is the redemption price minus the liability component. So, if at all in between it is redeemed, then what you will do? First, you will calculate what is my revised financial liability. That is the amount we are redeeming towards financial liability. Now, difference between the carrying amount and this amount that I have calculated will be recognized in P&L, and the equity component will be nothing. Redemption of equity component will be the total price minus the liability component. Now, if it is redeemed on maturity date, what you will do? Debit the financial liability if at all it has a balance, debit equity component, credit cash, credit other equity if it is redeemed. If it is converted, if there is any balance in debit financial liability, debit that, debit equity component, credit equity share capital, and credit security. Right? Now, another very important part is this modification of financial liabilities, that is typically referred to as debt restructuring. Here, typically, you will get a question. If a question comes, it's for 14 marks. A lot of students get scared. I'm telling you, practice 3 or 4 questions. You will have superb confidence when you go and write the examination. Now, whenever there is a modification of financial, liability, first thing we have to check is whether it is significant or substantial modification or not. Do we need to de-recognize the existing liability and recognize a new liability, or do we need to carry out modification accounting? How do you do that? First, you will compute the carrying amount of existing financial liability as per normal computation. Second, compute the present value of cash flows considering revised terms using the original rate. This is very important. What is the revised terms, consider all of that. So generally what happens is, in case of debt restructuring, let us say a company has taken loan. A company has taken loan from a financial institution. Okay, loan is taken. On this loan, the initial principal amount is 10 lakhs and interest at 10% is payable. After 3-4 years, they realize that no, it is difficult, we cannot pay, let us renegotiate, let us revise the term. Now, as per the new terms, what the bank says is, from year 4 onwards, for example, you have to pay me not 10% but 12% interest. Existing interest I am waiving off, but 12% interest you have to pay, and at the end of 15th year or 14th year, you have to pay back 10 lakhs, something like that. Okay. Now, considering this revised term, using the original rate, which rate? Original discounting rate that you have taken, that rate you will consider and calculate what is the present value. Okay, what is the present value? Now, step 1 and step 2 I have done. This is the carrying amount. This is the present value based on revised term. You will see what is the difference. You will see what is the difference. If the difference is 10% or more of the carrying amount, then we use the extinguishment accounting. Otherwise, we will use the modification accounting. Sir, what is this extinguishment accounting? Any existing liability you will derecognize. Any existing liability you will derecognize. New liability you will compute by using new rate. Here you have taken original rate. Now you will compute the liability using new rate. And any amount if you have paid for extinguishment, any charges and all of that, that you will take it to P&L. And the difference between these two also will go to P&L. Or you can debit financial liability old, credit financial liability new, credit bank if you have paid any, and the difference will be recognized in P&L. That is extinguishment accounting. Please remember, for comparison, we will take the original rate. For accounting subsequently, we will take the new rate. That is the first thing. Now, coming to the second part, when the difference is less than 10%, first thing what you will do is, whatever is the transaction cost will reduce from the financial liability. Okay, this becomes your carrying amount. Then you have calculated present value of the cash flows of the revised terms using the original rate. In that case, you will take the original rate and see what is the present value of all of these cash flows. Means you will not change the rate. You will not change the rate and calculate the present value of the new terms, because your cash flows have changed and the difference will be recognized in P&L. That is one choice. Or you will consider the current carrying amount of financial liability and what is the revised cash flow. For this, you will calculate a new rate, which is the effective interest rate. So there are two ways to do. Number 1, first you will remove the transaction cost from the whatever is the transaction cost, you will debit it to the financial liability. That carrying amount will compare with present value of the new cash flows with old rate. The difference will be recognized in P&L. Or whatever is the new cash flow, you will compute an effective interest rate and you will continue to account for it without recognizing in P&L. So let's look at a question on this from examination. 12 marks. Again, you have to be very calm and careful when you are solving this in the examination. Then you will be able to score 12 out of 12. Coupa Limited borrowed 95 lakhs as loan from XYZ Bank on 1st of April at an interest rate of 10% per annum. Coupa Limited spent 1,80,000 as loan processing charges. Principal amount of loan is to be repaid in 5 equal installment and interest to be paid annually on accrual basis. Effective interest is 10.8%. Why this effective interest is given? This effective interest rate is given for us to account for or to calculate the present value. Okay. On 31st March, Coupa Limited, which date? 2020. When did they borrow? 1st of April of 18. Very careful with the dates. 1922 years. They faced challenges in business because of sudden change in the technology. It approached the bank and renegotiated the terms of the loan. Interest rate changed to 15% per annum. Principal amount is to be repaid in 8 equal installment payable annually starting 31st March, and the interest is to be paid annually on accrual basis. Okay, so you will now pay in 8 equal installment. Before approaching the bank, they made the interest payment on 31st March. So, they paid interest on 31st March of 19 and they made interest payment on 31st March of 20. So, interest is paid. What is left? Principal is left. Only the principal part is left to be negotiated. You are required to record the journal entries in the books of Coupa Limited till 31st March after giving effect of changes in terms of the loan on 31st March. Working should form part of your answer. Okay, they give the present value factors. Now, loan is how much? 95 lakhs. So, your loan is 95 lakhs and you have paid 180,912 as the transaction fee. So, the difference net amount is 93 lakhs 19,000. What is this 93 lakh 19,000? This is your financial liability. This is your financial liability. So, 93,19 is your opening balance. Then, how much is the interest? On this 93,19 19,088. They have said that interest rate effective is how much? 10.8%. So we'll take 10.8% into 10.8%. If you do, you get 10,06,462. Opening balance plus interest. This interest, will this interest be paid? No. The interest that you will pay is the contractual interest of 10%. So in the first year, they would pay 9,50,000 of interest, that is on 95 lakhs, and 19 lakhs of principal, because they have said loan is to be paid in 5 equal annual installment. So for 95 lakhs of loan, what will be paid in the first year? 19 lakhs. So how much is the cash flow? 19 plus 9,50,000. Total cash flow is 28,50,000. Opening balance plus interest minus cash flow or payment gives you the closing balance. Second year, opening balance. How much is the interest? On opening balance, interest expense is 10.8%. What do we need to pay? Interest of 760. So how do we get this 760? See, out of 95 lakhs, they have paid 19 lakhs. 7,60,000 or 76 lakhs is pending. On that 10% is 7,60,000. Principal 19 lakh repaid, total payment will be 2660. Like that you can calculate. Okay. Now, at the beginning, you will debit bank account with transaction price minus processing charges 93,19,000. Then on 31st March, interest expense booked, payment to bank 2850 and balance amount will be debited to loan account. Okay. Then on 31st March, you have paid 7,60,000 as interest. Your interest expense is 8,07,000. Difference will be credited to the loan account. So now, what is the loan account balance? Loan account balance is 74,75,550. 74,75,550 plus interest of 8,07,359 minus you have paid 760. You did not pay this. Minus 760. If you do, you get 75,22,909. Carrying amount of the loan is 75,22,909. Alright, that is the carrying amount of the loan. Now, with this carrying amount of loan, we have to see what is the new cash flow. What is the new cash flow? And based on the new cash flow, what is the present value? Now, sir, what is the new cash flow? See, principal of 76 lakhs is outstanding. Principal of 76 lakhs is outstanding. This we have to pay over how many installment? They have said you have to pay over 8 installment. So 76 lakhs of loan that is outstanding divided by 8 if I do, every year my cash flow is 9,50,000. Every year my cash flow is 9,50,000. 1, 2, 3, 4, 5, 6, 7, 8. That is my cash flow. Then interest has to be paid at what? 15%. 15% of what? Of this principal value. So 76 lakhs into 15%. If I do, I get 11,40,000. Second year interest will be 76 lakhs minus, you have 76 lakhs minus 9,50,000 minus 9,50,000 into 15%, your will be 9,97,500. Like that you have to calculate the interest payment. Now this is the actual payment. This is the actual payment. Now what is my total cash flow? Principal plus interest. This new cash flow, please remember, this is the most important thing. This new cash flow you have to discount at the original rate discounting. What is that? 10.8%. What is the present value? When you calculate that, present value comes to 86,42,000. Difference 11,19,000. Is it more than 10%? Yes, it is more than 10%. If it is more than 10%, existing loan 752209 will be extinguished. And you will get to the new loan. You will get to the new loan. Now, what is the value of new loan? The new loan will be considered at what? The new rate. What is the new rate? 15%. So, if the 76 lakhs of loan is there and the discounting rate is 15%, interest is also paid at 15%. So, the new loan will be 76 lakhs. And the difference will be debited to P&L. Right? Then, subsequently, on 31st March, what you will do? You will book the interest expense of 11,40,000. How do we get 11,40,000? Now 76 lakhs into 15%. So your interest expense is 11,40,000. Amount paid to bank is principal plus interest, and the balance amount will be debited to the loan account. Okay, so that is how you have to compute. There are a couple of more varieties in the study material. See, the treatment is same, the process is same, just that they will confuse you with this cash flow. Loan to be repaid in so many installments. So when you have to calculate the new cash flow, that is where you have to be very, very careful. So what did we do? What do we do in the examination? If you get a question, first step 1 is to calculate what is the carrying amount. What is the carrying amount? If you have paid any transaction fees and all of that, you will debit it to this amount only if it is under modification accounting. But first you will calculate the carrying amount. Then you will calculate present value of new cash flow using old rate. If the difference is 10% or more, then you will follow extinguishment accounting. Extinguishment accounting means what? Extinguishment accounting means you will de-recognize the existing liability, you will de-recognize the existing liability, you will recognize the new liability, and the balance will be debited or credited to P&L. Now, as far as transaction cost is concerned, if it falls in the second category, then you will not transfer it to P&L, you will adjust it from the financial liability. If it falls under extinguishment accounting, if you have paid any transaction cost, that will also be debited to P&L. Alright. Now, another important topic which you need to be careful about is the financial guarantee contract highly scoring. Now, what is this financial guarantee? Let us say you have a holding company and you have a subsidiary company and there is a bank. Okay. Now, subsidiary company wants to take a loan from the bank. Bank says, no, boss, you are not making profit. I need guarantee. Subsidiary reaches to holding company and says, I need guarantee. The bank is not giving me loan. Now, holding company has given a guarantee. Because holding company has given guarantee, bank has given the loan. Now, typically when a bank or any financial institution or any company provides guarantee to the other party, they will want something in the return because holding company is taking a risk. Now, in case of holding subsidiary, if they don't charge anything, but benefit is being given to subsidiary, correct or not? Holding company is giving some benefit to subsidiary, because of which they are able to get the loan from the bank. So, this benefit has to be accounted. Now, what is the benefit? Let us say without guarantee, the rate is 12%. And with guarantee, the rate is 10%. The savings of 2% is the guarantee amount or the benefit that has been provided by the holding company to the subsidiary company. How do we value that? Whatever is this 2%, you will discount that at the market rate, that is 12%, and then you will get to the present value. This present value of benefit is nothing but the amount of benefit that the holding has given to subsidiary. And holding recognize that amount as a liability because if at all it defaults, it has to pay some amount, and hence this present value of benefit that is provided is a representative of the loss if at all the holding company has to bear, because the holding company will not bear more loss than the benefit that is given to the subsidiary, correct or not? If the subsidiary is getting only 2% benefit, why will holding company bear a higher risk? They will not bear. So we'll assume that this 2% of benefit itself is the value of the liability. So we'll solve this with an example that will help you understand better. Again, 12 marks question. On 1st April of 21, Fortunate Bank has provided a loan of 25 lakhs to Mohan Limited for 4 years at 10%, and the loan has been guaranteed by Surya Limited, which is a holding company for Mohan Limited. Interest payments are made at the end of each year and the principal is repaid at the end of the term. If Surya Limited had not issued the guarantee, Fortunate Bank would have charged Mohan Limited an interest of 14%. Surya Limited does not charge Mohan Limited for providing the guarantee. If any amount is charged, then it is more like a consideration for a service provided, and accordingly will recognize as per principles of Ind AS 115 and also Ind AS 109 if applicable. On 31st March, there is a 2% probability that Mohan Limited may default on the loan in the next 12 months. If Mohan Limited defaults, Surya Limited does not expect to recover any amount. On 31st March, there is 4% probability that Mohan Limited may default on the loan in the next 12 months. If Mohan Limited defaults, Surya Limited does not expect to recover any amount. On 31st March, there is a 5% probability that Mohan Limited may default on the loan, and if they default, they don't expect to recover any amount. You are required to provide the treatment in the books of Surya Limited on initial recognition and subsequent period. Who Loan has been guaranteed by Surya Limited, so Surya Limited is taking up the liability. What is the liability? Liability is nothing but the present value of savings. How much is saved? See, if the guarantee contract was not there, you have to pay 14%. If the guarantee contract is there, you have to pay 10%. So the difference between these two is the savings. 1 lakh of saving every year. So total saving is 4 lakh. The present value of the savings that is attributable is discounted at 14%. So you get to the present value of 291,300. This is the value of benefit that is provided by the holding company to the subsidiary company. So what is the entry? Entry for that will be investment in subsidiary to financial guarantee 291,300, 291,300. Alright. Then subsequently what do we do? I have said investment in subsidiary because I am providing a benefit to the subsidiary, and I have credited a financial guarantee liability account because that is the liability I am expecting if at all there is a default. Because if the liability is more, I will not take a risk higher than that. I will take a risk only to the extent of what the benefit subsidiary is getting. Okay. Now subsequently what do we do with this 291,300? We prepare an amortization table of this liability. Opening balance, interest at 14%, benefit that is provided, closing balance. Opening balance 291,300. What is this interest? To increase the liability because you have discounted. What is the benefit provided? See, interest saving is 1 lakh. That is the benefit that the subsidiary has received. So I have already completed my obligation for 1 year. You can think of it that way. The holding company has completed its obligation of 1 year. 1 lakh worth of benefit has been provided to the subsidiary. So what is the closing balance? Opening plus interest, benefit, closing balance, which is 232. Now here what they have said is there is a 2% probability of default, 4% probability of default, 5% probability of default. What is this 2% probability of default? Loan is 25 lakhs. Loan is 25 lakhs. Now what is the loss if at all it is defaulted? 25 lakhs into 2%. 25 lakhs into 2%. 25 lakhs into 2%, 50,000. This is the liability. Now my current liability of unearned revenue. Now what is this unearned revenue? Think of it. If this guarantee was provided to some other party, then we would have charged 291,300. We would have recognized interest of 40. Benefit we have already provided 1 lakh. So the closing balance is 232. So the difference between opening balance 291 and closing balance 232. 291 minus 232. 59,000 is the revenue to be booked. My income. Out of this 291,000, I have to book an income of 59,000. So that will be booked by debiting the financial guarantee, crediting the P&L account on 31st March of 22. So opening balance plus interest minus payment, you get to the closing balance. My liability is now only 232. Initially my liability was 291. This different is the income that I have earned during the period by providing the guarantee, which is the difference is 59,218. Second year closing balance is 164. Now 164, the default rate that what they have given is 4%. 4% default means 1 lakh. So again my expected liability or loss is 1 lakh. My carrying amount of liability is 164. I will continue to carry at 164. 232 minus 164 I will recognize in the income statement. Third year 87. Loss probability 5%. If loss probability is 5%, then 2%, this becomes 1,25,000. So I am saying my closing balance of liability is 87, but the expected loss, if at all there is a default, is 125. So I have a liability of 1,25,000. I will take the closing balance to 1,25,000. I will not book it at 87. I will book it at 1,25,000. 164 to 125. The difference 164 minus 125. I get 39 is booked as income. So here income will be difference between 164 and 125, 39,573, 39,573. In the last year, if there is no default, entire 1,25,000 will be booked as income. Okay, this is a standard question, slightly lengthy, I agree, but if you just remember the steps, you can score 12 out of 12. There cannot be a mistake in this question. Okay, so please do this. So this we have already done using the question that we have just now discussed. If you want, you can just go through the concept once. Then we have derivative instrument. Now what is derivative? Derivative is a contract which has the following characteristic. Value changes due to underlying factor. So say for example, I have taken a call option or a future contract on a share. Share prices changes, the value of derivative changes. The value of call option changes, the value of put option changes. There is no or little initial net investment. If I had to buy 1000 shares of Reliance, I had to invest huge amount. But if I have to buy 1000 call options on Reliance, I have to pay very less amount. And transaction will be settled in future. Transaction will be settled in future. Okay. So this is the characteristics. If the value of contract changes with respect to non-financial variable and the non-financial variable is specific to one of the party, then those kind of contracts do not fall in the nature of derivative. Derivatives are accounted using fair value through P&L, and if it is a hedging instrument, we'll apply hedge accounting. What are the types of derivative? Forward, futures, options. All of you will be master in AFM based on this. And just a quick thing, a lot of students get confused. If it's a long position, we buy. If it's a short position, we are selling. If it's a buy call, there is an option to buy. If there is a buy put, there is an option to sell. If there is a sell call, there is an obligation to sell. So a lot of students get confused between sell call and buy put. Sell call means I have sold the call. The other party has purchased the call. Other party has an option to buy. I have an obligation to sell. Sell put is an obligation to buy, and this is the expectation of pricing. Now, as far as accounting is concerned, for forward and future contract, initial fair value is 0. So, on the date of inception of the contract, there is no accounting entry. There is no accounting entry. For option, initial premium that is paid or received will be accounted. For option, initial premium paid or received will be accounted. If I paid a premium, it will be a financial asset. If I have received a premium, it will be a financial liability. Subsequent measurement, fair value, gain or loss recognized in P&L. Very simple and straightforward. In fact, in the previous attempt, in the November attempt, they had asked a very simple question, very simple question on derivative. Just that they had, instead of saying that there is a buy future, it was a return put option. So, if it is return put, return put, there is an obligation to buy. So, if you remember this, you will be able to handle that in the examination. As far as there is a favorable position, it's a financial asset. Unfavorable position is a financial liability. The holder option of an option will exercise only if the option is beneficial. You will be champions in AFM. I don't need to explain this further to you. Then there is a topic called embedded derivatives, which is very scary, very lengthy, too much of text and theory to be remembered. I don't want you to waste unnecessary time for this in the examination. There are only 3 or 4 things that I want you to understand, and one type of question which you need to work out so that you have the confidence for the examination. Okay. Now, what is an embedded derivative? It's a component of a hybrid contract that includes a non-derivative host with the effect that some of the cash flows of the combined instrument vary in a way similar to the standalone derivative. Simple example, convertible bond. In convertible bond, there is a bond and there is an option to buy or convert to equity shares. Okay. Now, this bond is a non-derivative and there is an option to convert, that is a derivative. So, when you have both of this is the host which is non-derivative and this is the derivative contract. Now, the peculiar thing about a embedded derivative is that if there is a host and there is a derivative, do I need to separate this for my accounting purpose? Do I need to separate this for my accounting purpose? Now, what you have to understand is, when do we account for it as a single contract and when do we account for it as a separate contract? For separate contract, if the economic characteristics and risk of the host are not related to the embedded derivative, so what is the characteristic of host? If that is different from the embedded derivative, you will separate. In some cases, you will account for it as a single contract if it is a financial asset. If it's a financial asset, you will account for it as a single contract. And in other cases, if the economic characteristics and risk are related, separate standalone does not have a feature of derivative, means a separate standalone contract, if I separate it, it doesn't have the feature of derivative, and if it's a hybrid contract measured through at fair value through P&L, in that case again I will do a single contract accounting. Okay. Now, here is where you will understand when do we separate, how do we account for it when it is separated. If it is separated, then derivative will be accounted using FVTPL, initial recognition at fair value, subsequently through fair value through P&L. Host contract as per the applicable guidance applicable to financial liability. If it is not separated, account for it as a single derivative contract through P&L. Host contract and embedded derivative, if it is accounted for as a separate contract, then if fair value of embedded derivative, if it is determinable, measure embedded derivative at fair value, and the value of host contract is total minus fair value of embedded derivative. If it is not determinable, then determine the value of host contract. If you can determine, first measure the host, check for the total fair value of hybrid and the value of embedded derivative is difference between the two. If it is not, then designate the entire contract as FVTPL. And there is one specific question on post contract and prepayment option, that you please work out that question once so that you have a grip on what is this particular concept. As far as embedded derivative is concerned, I would want you to focus more on solving the questions rather than understanding the theory, because anyways derivatives we find it complex. Embedded derivative theory part, accounting for it is more and more complex. So just give a couple of reading of my notes or of these charts or whatever notes you are following. Apart from that, don't break your head on it at this point of time. Then there is a question on foreign currency embedded derivative, that's also very important. So here first we need to see whether there is a foreign currency embedded derivative in a particular contract. A typical example is there is an Indian buyer and then there is an Indian seller. Okay, they agree to sell, let us say, a machinery. Amount will be paid in USD. Now typically if the functional currency of the Indian buyer is rupees, for the seller is also rupees, why do we designate the contract in USD? So here where the standard comes up with the concept of foreign currency embedded derivative. They are saying that these are not a single contract, these are two separate contracts. One contract is to buy and sell the machine, second contract is to buy and sell the USD. So if some conditions are satisfied, this foreign currency embedded derivative has to be separated. It has to be separated and account for it as an embedded derivative. Now when do we separate? We will separate if, or when do we not separate? We will not separate if the settlement is in either functional currency of substantial party. So if the settlement happens in one of the party's currency, that is in this case rupees, then you will not separate. Or the currency is used for normal transactions on those asset being traded. If you are selling a machinery and buying a machinery in India, you will not sell it in dollars. Crude, internationally crude is quoted in dollars, but machineries are not. Same way, it is settled in the currency of economic environment where the transaction price is determined. So something is, let's say, determined out of Singapore or Middle East and all of that. What is the currency used there? If you are designating in that currency, no problem. If these three conditions are not satisfied, means it is not the currency of one of the party. Second, it is not the currency used in normal transaction. Third, it is not a currency of the economic environment from where the transaction price is derived. If these three conditions are not satisfied, then what you will do? You will segregate. You will separate the post contract with the foreign currency embedded derivative contract. So we will look at a question. Company A, an Indian company whose functional currency is rupee, enter into contract to purchase machinery from an unrelated local supplier, Company B. The functional currency of the Company B is also rupees. So both the functional currency are rupee. However, the contract is denominated in USD since the machinery is sourced by the company from US base. See, wherever I buy from, is it my substantial, is it a currency of one of the parties? No. Is machinery normally traded in USD in India? No. So even if you have imported, doesn't make a difference. Payment is due to the company on delivery of the machinery. Order date 9 September, delivery date 31st, purchase price 1 million USD. Forward rate on 9 September for 31st December maturity 67.8, spot rate on 9 September 66.4, forward rate for 31st December on 30th September 67.5 and 31st December 67. These are the rates given. Company A is required to analyze if the contract for purchase of machinery from Company B contains an embedded derivative and whether this should be separately accounted for on the basis of guidance given on Ind AS 109. Give the necessary journal entry. So first you explain that, see, the host contract is a non-financial asset, it's not measured in FVTPL. Requirement to settle in USD, it behaves like a standalone forward contract. USD is not functional currency of either party. Machinery is not routinely denominated in USD. USD is not a commonly used currency for domestic transaction in India. Hence, there is an embedded derivative. Now, how do we measure it? Initially, so you have two parts. One is there is a foreign currency derivative. Okay, foreign currency derivative. That foreign currency derivative, initially, what is the fair value? Now, what is the fair value? See, on 9th of September, it is at 67.8. The quote for 31st December is 67.8. Fair value of the forward contract is 0. Subsequently, on 30th of September, the price becomes 67.5. So then we will account for changes in value of the contract. Okay. So originally there is no entry. Subsequently, the rate has become 67.5. The rate has become 67.5. Now, in whose book are we accounting for? Company A is required. So we are counting in the books of company A. Company A will purchase. So A will purchase machine and A will give dollars. A will give dollars. Now when I say A will give dollars, can I say A has sold dollar futures? Yes. If I have sold dollar futures, if the price reduces 67.8 to 67.5, is it a gain or a loss? It is a gain for me. Correct? So what I will do, I will recognize a gain of the difference by, and when there is a gain in derivative contract, derivative asset debit to P&L 300,000 or 3 lakhs. Then on 31st of December, what happened? On 31st of December, now the rate has come down to 67. So again, there is a gain of 67.5 to 67, gain of 5 lakhs. 67.5 to 67, gain of 5 lakhs. So these two gains I will recognize. Then at what value will I record the purchase of machinery? Property, plant and equipment will be purchased or recorded using the rate, forward rate, that is 67.8. Because if I am buying, I am expecting a cash outflow and I would have taken a forward contract, that underlying forward contract kind of a thing. I am settling in dollar, but if I were settling in USD, I would have taken a separate forward contract for future cash outflow. Okay. So 67.8. To bank, I will have to pay only 67 lakhs. The difference is basically the realization of this derivative asset of 8 lakhs. And hence PPE is recorded at 67.8 lakhs. Now, if you remember in the hedge accounting also, there is a forecasted cash flow. There is a forecasted cash flow. And whatever is the gain or loss on the derivative is added when you purchase a capital asset. The same treatment is given here. Alright. So that is one more thing you have to keep in mind. Please practice this very important question from examination point of view. So there I have given you the steps. You can have a look at it subsequently. Then comes hedge accounting. Hedge accounting is basically, on one side I have a normal transaction. Let us say I buy and sell copper. Because there is a fluctuation in prices of copper, I take a corresponding hedge. Let us say I take a future or forward or option. That is what we are understanding in hedge accounting. No great questions, but understand it conceptually. First, when we talk about hedge accounting, there is a hedge item which is an asset or liability that has to be hedged, and there is a hedging instrument. Okay. Now, depending on what is the nature of hedge, we call it either a fair value hedge, cash flow hedge, or net investment in foreign operation hedge. So, what is a fair value hedge? Just remember, fair value hedge is for something. If I have an asset or a liability, I want to protect its fair value. So, hedge of exposure to changes in fair value of recognized asset or liability, or an unrecognized firm commitment. Unrecognized firm commitment. I have entered into a contract to buy something. Will I record it? I will not record it. But I have entered into a contract. So, if I am hedging these two, one of these two, then it is called a fair value hedge. For fair value hedge, the hedging gain or loss is taken to P&L. To EBIT OCI if it meets the criteria for OCI classification, and the hedged item gain or loss is recorded in P&L. So P&L and P&L, these two will offset. Meaning to say, let us say I bought copper. I have taken a hedge. The copper prices fell. In hedging, I will have a gain. So this gain will be recognized in P&L. This hedge gain loss will be recognized in P&L. If it is still lying in inventory, right? So I'll value it, the loss will be recognized in P&L, gain will be recognized in P&L. Now, sometimes what happens is, prices may go up and here I'll have a loss. In that case also, I'll increase the value of my inventory to avoid any accounting mismatch. Then, second category, so if at all, there is a gain in inventory, I may have to adjust the gain against the hedged item. But the thing is, I will recognize fair value hedges in, the impact has to go to P&L. Or if it is an item sitting in the balance sheet, let us say inventory, and the inventory value have to increase, I may transfer to the inventory account. Okay. Then comes cash flow hedge. What is cash flow hedge? Hedge of the exposure to variability in cash flows arising out of recognized asset or liability, or highly probable forecasted transaction that could affect the P&L. Now again, cash flow. I have to pay cash to someone. I want to hedge that. To be a cash flow hedge. Or there is an unrecognized probable forecasted transaction. Meaning to say, I am thinking of buying in the future. See, here I am saying unrecognized commitment. I have already committed. Here I am not committed. I am thinking. I am thinking. Should I buy? Should I not buy? Or I may buy in the future. Because I may buy in the future, I have taken a hedge. That is called a cash flow hedge. Now, as far as cash flow hedge is concerned, the effective portion of it is recorded in OCI, ineffective portion is taken to P&L. Subsequently, the cash flow hedge reserve is adjusted against the non-financial asset or liability in future or added to the firm commitment. Like we did in the case of previous example, there is an underlying forward contract, this acts as a kind of hedge that I am adding to the cost of the asset itself. Okay, that is the cash flow hedge. Then we have NIFO hedge, that is net investment in foreign operation hedge. If I have investment in a foreign operation and if I want to hedge the foreign currency fluctuation, that effective portion is taken to OCI and effective portion is taken to P&L. Just remember this. If you are able to remember this, then it is more than sufficient. Okay. Then we have derecognition of financial asset. Derecognition is simple. If at all the risk and rewards have been transferred, we will derecognize. Sometime a part of the financial asset may have been transferred. Then in that case, you will split the carrying amount on the basis of fair value between the retained and transferred portion. So for example, if I let us say I have a debenture. On this debenture I have interest and I have principal. I have agreed to transfer the interest, retaining the principal. So, carrying amount of debenture will be split between interest and principal. Whatever I have transferred, this will be derecognized. Whatever I have retained, I will continue to recognize. Now, let's move on to the next one, impairment of financial asset. Financial asset, three categories, we know amortized cost, FVOCI and FVTPL. Now, when it is FVTPL, impairment is not applicable because it is already measured at FVTPL. For amortized cost, impairment is applicable. For FVOCI, for debt, impairment is applicable. For equity, impairment is not applicable. Now, you say, sir, here also we are measuring it at fair value. How is impairment applicable? Here, debt has contractual cash flow. So, even if I am measuring it at fair value, if the contractual cash flows are less, present value of contractual cash flows are less, then this may be further impaired. So, first, I will calculate what is the contractual cash flow, what is the present value, and is there an indication of impairment. Second thing is, fair value gain or loss is taken to FVOCI, impairment loss is taken to P&L. That is why it is important to recognize impairment loss. Here, FVTPL, whatever is the change in value goes to P&L only. So, there it is not required. Okay. Then, we have a concept called expected credit loss. Present value of difference between the contractual cash flow and expected cash flow is the expected credit loss, and we compute two things, 12 months and lifetime expected credit loss, and depending on that depending on various category of asset, we book the losses. Now, for trade receivables, we will directly take the loss given default into probability of default into carrying amount. So, they will give you some percentage. There is a 10% probability of default. Default is 0.5%. Multiply that with carrying amount of 10,000 and you will book the loss. There is one standard question. Please revise that question for the examination. Whereas if you look at the purchased or originated credit impaired asset, if you have purchased any credit impaired asset or the credit impaired asset were impaired at origination, then you will compute the effective interest rate considering the fair value on the date of transaction and expected cash flow. Subsequently, if cash flow deteriorated, we will provide for impairment. If there is no significant increase in risk, you will take 12 months ECL and income is recognized on gross amount. If it is significant increase in credit risk but no impairment, lifetime ECL, so that is where this is used, 12 month and lifetime, and income is again calculated on gross. If there is clear evidence of credit impairment, lifetime ECL and income on net amount. So these three things you please remember. Then we have a concept of reclassification of financial instrument. Now, as far as reclassification of financial instruments are concerned, from ACM to FVT OCI, transfer at fair value, difference is recognized in OCI. ACM to FVTPL, transfer at fair value, difference in PNL. FVT OCI to ACM, transfer at fair value plus or minus accumulated balance. So this again it will bring it back to ACM balance only. From FVTPL to ACM, transfer at fair value, compute new EIR. So from FVTPL, whether you take to ACM or FVT OCI, you will transfer at fair value and compute new EIR. From FVT OCI to FVTPL, you will transfer at fair value and transfer accumulated balance in OCI to PNL. Remember this chart, very important for MCQs point of view. Now, as far as type of questions are concerned in the examination, one is compound financial instrument. Second one is this with mid-term redemption. Okay. Then you have loan at concessional rate. Then you have financial guarantee contract, which you have to be careful about. Then you have modification accounting. Then you have foreign currency embedded derivatives, that also very, very important. Then you have derecognition related aspects and reclassification related aspect. This also you have to be careful, especially when this loan is given, right? Employees loan and all. Read the terms and conditions very carefully, compute the cash flows carefully. Same thing goes with modification as well. Read it very, very carefully so that you can account for it. FC, this we have already seen one question. Then for embedded derivative, solve all questions. If you are worried about theory, leave the theory, at least solve all the questions from the examination, compiler that we have, or from the study material. That gives you some amount of comfort before you go to the examination, right? So these are the broad area, focus areas, when it comes to your examination. Focus area: compound financial instrument with midterm redemption, concessional loan, financial guarantee, modification, foreign currency embedded derivative. This is important. And embedded derivative, solve all questions, including derivative questions. Some of us have this habit that it was asked in the previous attempt and hence they will not ask. There have been cases where they have asked back-to-back loan questions. So don't think, and see, they can pick up that question and give it for MCQ also. So accordingly, you would be able to, do it properly. I hope this quick revision is helpful for you to quickly brush up one of the vast topics of financial reporting. And of course, you already have my important questions list. You can go through that list, practice them properly and do well in the examination. All the best.